I am afraid that gold and silver are headed much higher. I say afraid
Afraid,
because,
right?
to be completely
I,
honest, I'm old and fat and rich. Gold does well during periods of time when people's concern about the maintenance of their savings in US dollars are challenged. In other words, gold does well in bad times. I own gold because I'm afraid, not hopeful, I'm afraid it'll go to $6,000 or $7,000. In my experience, gold has to establish the pattern, but then silver outperforms it. Honestly, Mike, I have no earthly idea what the silver market might do if the gold market tripled or quadrupled.
RickRule, a prominent voice in investments, has delved deep into the consequences of surging yields, exploring the potential market repercussions and the promising prospects for gold and silver investors. Rule's predictions of gold reaching $6,000 to $7,000 and silver following suit have drawn attention. As gold prices marked a 3-month high and secured a second consecutive weekly gain, their resilience is attributed to the ongoing Middle East conflict and the anticipation of the Federal Reserve's forthcoming rate hikes. Meanwhile, silver currently hovers around $22.85, reflecting a modest gain of 0.29%. The recent dovish remarks by Federal Reserve Chair Jerome Powell at an economic forum contributed to a drop in the dollar's value, further boosting precious metals' appeal. The dollar dropped on Thursday after Federal Reserve Chair Jerome Powell was interpreted as being generally dovish in comments made at an economic forum. RickRule emphasizes the historical tendency of precious metals, particularly gold, to thrive in economic uncertainty and when concerns about the US dollar's value arise. Additionally, he highlights the unique dynamics of silver, which often outperforms gold when the latter is experiencing positive market trends. Silver price faced negative pressure to break $23 and settled below it, but we noticed that stochastic gains the positive momentum. At the same time, the EMA 50 keeps providing positive support to the price. He highlights that investors often turn to silver because silver typically outperforms gold when the gold market is performing well. Before diving into RickRule's insightful interview, subscribe to our channel and give this video a big thumbs up.
I am afraid that gold and silver are headed much higher. I say afraid because,
right?
to be completely
I,
honest, I'm old and fat and rich. Gold does well during periods of time when people's concern about the maintenance of their savings in US dollars are challenged. In other words, gold does well in bad times. I'm 70. I just as soon not see any bad times. I'm afraid you're right too. I got a lot of questions at this conference I was just at about, will gold break through 2000? I don't care. I don't own it because it would go from $1,925,000 to $2,050. I own it because of the lessons that we learned in 2000, where it went from $253 over 10 years to $1,900. I own gold because I'm afraid, not hopeful, I'm afraid it'll go to $6,000 or $7,000. I certainly don't have the preponderance of my net worth in gold, just like I don't have the preponderance of my net worth in any insurance product. Gold to me is an insurance product. Now, I will admit, on occasion, I speculate as opposed to invest in silver. I do that because in my experience, when the narrative is driven by gold, which is to say when the precious metals market momentum is driven by gold, silver, for whatever reason, perhaps it's lower unit cost, travels further and it travels faster. In my experience, gold has to establish the pattern, but then silver outperforms it. And honestly, Mike, I have no earthly idea what the silver market might do if the gold market tripled or quadrupled.
right.
I have real fears, not hopes, fears that the gold market will triple. Let me give you, I always revert to math. I'm a credit guy, really.
Yeah.
The market share of precious metals and precious metals related investments, securities, stuff like that, gold stocks, comprise less than one half of 1% of total savings and investment assets in the United States. As Robert Friedland would say, a pimple on an elephant's behind. The 2-decade mean market share of precious metals among U.S. savings and investment assets is 2%. So if concern about quantitative easing, debt and deficits, negative real interest rates became a little more broadly spread in the U.S. economy, and if the market share of precious metals returned to mean, I'm not talking about crushing the bond market. I'm talking about returning to mean. Demand for precious metals and precious metals related assets in the United States would quadruple. And that's precisely what I think is going to happen.
On May 1st, 2023, a significant financial upheaval unfolded in the United States as regulators took control of the troubled First Republic Bank and swiftly orchestrated the sale of all its deposits and most of its assets to J.P. Morgan Chase, the country's largest bank. This intervention aimed to mitigate the escalating turmoil within the banking sector. Despite receiving a substantial $30 billion lifeline from 11 of the nation's largest banks in mid-March, the FRB's financial distress proved insurmountable. The crisis in the regional banking sector had been simmering since early March and was characterized by the rapid collapses of Silicon Valley Bank and Signature Bank. Notably, 2023 bore witness to 3 of the 4 largest bank failures in U.S. history. These 3 failed banks collectively held assets amounting to $532 billion, surpassing the $526 billion held by the 25 banks that succumbed during the financial crisis 2008. RickRule offers a piece of advice to individuals: closely monitor the health of their banks, obtain an accurate statement of the bank's financial condition, and exercise caution in scrutinizing how banks account for specific assets on their balance sheets.
And I must say, I am surprisingly pleased with the competence of the regulators, which is not something that I had anticipated finding. We have experienced a slow response, I would suggest, from the FDIC. And when I made some intemperate remarks about the slow response, and I think what you say is worth paying attention to. You know, banking, Mike, done right by mature adults, is a really good business. I mean, it's really, really, really a good business. You focus on customer service with your savers. You focus on reducing your cost so that you can pass some of the benefits of that to the depositors. You aggregate the deposits and you lend them prudently. You do something for the savers that they couldn't do for themselves. It's really a good business, and it is by nature a leveraged business. The problem is that too many bankers take the attributes of that business to an illogical extreme. The Fed considers a bank with a 7% equity slice to be well capitalized. I'm an old guy now. I've been in banking 40-something years, and I know that sort of 1 or 2 years out of 10, as a banker, you're confronted with some truly ugly surprises. That's the way it works. So the arithmetic that makes sense to me is that 10% is a much better number than 7%. Banks are supposed to have some money in them, equity in them. And we seem to have forgotten about that in the United States. And then there's this problem called duration risk. One of the ways that the unwise in banking make money is that they borrow in the near term and they lend in the long term, and they try and arbitrage those two. The difficulty with that is that if you borrow in the near term on a fixed rate and you lend, at a floating rate, and you lend in the long term at a fixed rate, an increase in interest rates wipes out your business. Some of you will remember the savings and loan business. That's what went wrong. There wasn't a catastrophic decline in real estate prices. There were people that experienced funding difficulties where they had long-term assets and no access to funds in the long term. And that's what happened to Silicon Valley Bank. It's what happened to First Republic Bank. It's what happened to Bank of America's earnings last quarter. In truth, people need to pay attention to their banks. They need to obtain something called the Statement of Financial Condition, which the bank must give you. And the accounting is very, very, very tricky. The regulators allow banks to hold long-term bonds on their balance sheet if they say that they're holding them to maturity with no mark to market, which is to say, if a bank holds a 30-year bond that was bought in a period where a 30-year bond would yield 2, and now the 30-year bond yields 4.5, so the capitalized value of the bond has fallen by half, the bank is allowed to carry that bond on their balance sheet at par.
Gold, a traditional refuge for value preservation during political and economic turbulence, has demonstrated a notable increase of 2.4% during the past week. In its assessment, Fitch Solutions suggests that gold prices have been bolstered by diminishing concerns over the possibility of another Federal Reserve rate hike occurring in 2023. The report maintains a neutral outlook for gold prices in 2023, projecting an average price of $1,950 per ounce. This stance underscores the evolving landscape of economic dynamics and its impact on the precious metals valuation. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.